Good morning, everybody. By the way, would you need a screen? Would you need to share a screen at any point, or you don't need?
We'll just do the conversation.
Okay. So good morning, everybody. While you're getting on the call, this is Danny Cherad here from Rye, New York. So good morning from Rye, New York. I will shortly introduce my guests today that are both in Chicago. So good morning, Andreas and Tony from Chicago. And while people are getting on the call, perhaps I will mention we have a busy week. 2 weeks ago, busy period actually. 2 weeks ago, we held probably the only conference ever actually in New York City to happen, during COVID. The first one we've done since COVID, so it was a big deal for us as well and for our families. And I'm very fortunate that Tony and Andreas here supported that conference as well and met with the families in person. We are now working on possibly doing another one in November. I will share more details later on. At the end of the month, we have an online conference for Canada and for the US for family offices with amazing speakers. At least in the US, our keynote speaker is John Katsimatidis from the famous Katsimatidis family, which is famous because of him. And many families like Rockefeller and Kennedy and many others that are speaking. And same goes for the Canadian conference where we have people like Saputo, Desmarais, De Gaspé, and others that will be speaking there. If you'd like more information about that, let me know. And this week on the day after, on Thursday, I believe, we have 2 sessions at 11 in the morning, Sarah Harrison from the Harrison family. And at 4:30, we have a discussion about breast cancer and everything around the fight of cancer with Perimeter, interesting company, but doctors that are some of the top in their space, which is why we do it at 4:30. It's the only time we could have gotten their attention. And for today's conversation, we're going to be talking about private equity and cannabis and how and what's going on in between. And I would like to present my guest today. So very energetic folks that started an interesting company in Chicago. Andreas Bodmeyer, principal and co-founder of Chicago Atlantic Group. He leads the portfolio management and operations. He's been working at the intersection of finance and analytics for over 10 years. In his past, he was a principal at a boutique technology and consulting firm, advising multinational and private corporations on Forex and commodity risk management, capital structures decisions, and investor relations. He was also the co-founder of an SEC registered online investment advisor for retirement accounts and built the firm's investment methodology and compliance program. Was a consultant to hedge funds. I think just reading your bio would be the major part of our conversation today. So very impressive work. He built the firms. He also served as a consultant for hedge funds, trading firms, commercial and consumer lenders, pharmaceutical companies, and did his academic research at the University of Chicago Booth School of Business focused on capital market. So that's a very impressive bio, Andreas. Tony Capel, principal and co-founder of Chicago Atlantic Group. As chief credit officer, he leads the underwriting and credit analysis for our loan portfolios. As a debt investor with over 10 years of experience in the specialty finance space, he has completed over 150 deals of over $5 billion in total credit. Before that, he was managing director and head of underwriting at Stonegate Capital, a private credit investment firm focused on lower middle market businesses and emerging brands. He was responsible for credit underwriting and the growth strategy of the loan portfolios. Before that, he was an underwriter at First Midwest Bank, at Gibraltar Business Capital, and again, another very impressive long bio. So I will stop reading your bio so we'll have time to talk. So good morning, Tony and Andreas. How are you doing?
Very good.
Very good. Excited to be here.
Excited to have you here. First of all, you know what I ask, unfortunately, everybody here is how COVID looks like in Chicago today. What's going on?
I think things are opening back up. Restaurants are at 40% capacity. Retail is back open, but it'll take a while to get back to normal. But things have progressed nicely so far.
Very okay. That sounds good. I mean, we've been talking to people from Montreal and other areas where it doesn't look as stable as this. Obviously, we're going to talk about what you guys do in private equity, in cannabis. We know the cannabis segment very well. We'll talk about what happened there. There was a bubble, after the bubble, the opportunities that came, and all of that. So maybe we'll start with you guys explaining to us what you guys do.
So Denny, we're focused on private credit in the cannabis space. So, you know, there is really limited amount of senior secured asset-based credit that has been offered, and kind of we got into this space because, you know, relative to traditional markets and traditional lending markets, there's a lot more opportunity in this space given the competitive landscape. So we look for usually vertical operators in limited license states. So that's primarily east of the Mississippi. And we're lending them capital for accretive reasons, generally M&A or growth CapEx to proven operators. And that's where our focus has been, and have been building a nice portfolio.
And before we'll get into more details, I mean, just I would assume that COVID-19, I know we have the question going on you know, later on, but COVID made things worse for so many companies in so many sectors, and distressed assets and distressed companies. So on one hand, I would assume that you probably are needed more than ever before, and you probably get amazing terms that a year ago you wouldn't have. But on the other hand, the risk, how do you, that companies would fail. How do you see, and again, I hope I'm jumping the gun, but I just want to understand, how do you see COVID implications on companies in the cannabis space?
Well, so what we saw, you know, we saw actually a pretty big pickup in underlying in business. So as many may be aware, most states determine cannabis as an essential business because they're considered in most states pharmacies. So what we saw, for the most part, everything was open, and we saw about a 30% increase in underlying revenue within our portfolio. So one thing we do is we actually track any of our deals that have retail presence. We, as one of the requirements of the loans, we like to look at their POS data, which gives us real-time access to their revenue. And overall, I think it was about a 30% blend of demand or increase in revenue, which it ultimately made these businesses generate a lot of free cash flow. Now, on the flip side, their ability to raise equity got a lot harder, like many other businesses when you know, we had the COVID shock. So our ability to get even more preferred and better terms increased during this period, and has continued to date.
And if you can tell more about, well, my next question is, how did you start Chicago Atlantic? But maybe share some more about, I read a little bit about your background, which is very impressive. How, if you can tell a little bit about that and how you ended up.
Sure. No, that's absolutely, no, that's important to know. So, you know, I started out, prior to this, I was head of credit and underwriting at Stonegate Capital. We were a lower middle market specialty finance fund here in Chicago. We had three areas that we focused on. One was traditional asset-based lending, distress/turnaround lending. The second was high growth businesses. So doing a deal within the collateral and then ultimately stretching a little based on growth targets. The third was recurring revenue and rediscount lending. So while I was there, this is a couple of years ago, as many investors may know, there's been a big shift of capital into alternative asset classes, private equity being the primary winner of that. But of course, private credit has been a huge beneficiary of this shift. So what happened over this period of time is that more capital are chasing the same deals. The deals kept getting worse, and the total consideration kept going down. So, covenants going out the door, operating leverage going up, balance sheet leverage going up, guarantees going out, everything that was kind of in the wrong direction. So while I was there, we actually started to see some of the early cannabis deals. Being in Chicago, we saw the GTIs of the world, the Crescos of the world. These are businesses now that are over $3 billion in market cap. And these guys would be coming and willing to, take a considerably lower amount of money on a relative basis, provide whatever structure you want from a lending perspective, guarantees, low LTVs, great covenants, and they would be willing to pay you, 50 to 75% more in rate. And in many cases, we're actually able to get a piece of the business through warrants. So obviously at that point, it made a lot of sense. Here you have an industry that's emerging that should have 20, 25% kind of compound annual growth rate versus, the traditional market that I would say is long in the tooth in terms of the overall cycle. So, I got with John and Andreas, both friends that I met through business school. We spent about 6 months researching the industry, traveling the country, learning the different dynamics. Every state's a different investment thesis. We did our first deal in April of 2019 to a tier 2 cultivator in Ohio. Then as a kind of a case study, we love what we saw. We launched the fund in September of 19, and we structured as an open-ended fund. So we're an income generating vehicle, paying out 100% of our net income on a quarterly basis. So think of a mutual fund that owns loans instead of stocks. And if you fast forward to today, we've now done 10 deals, a little over 60 million in total capital. To date, our investors have generated about a little over a 14% net return. That's cash pay quarterly, and that does not give effect of the equity kickers that ultimately are within the portfolio and within the fund, but obviously it hasn't generated any return yet because there hasn't been a liquidity event. So that's kind of how we got started and ultimately learned to love the industry.
So, and do you guys loan to, obviously the cannabis industry is big. Well, I come from Israel. It's very big in Israel, but it's big in the US. It's bigger perhaps in Canada. Do you guys loan for Canadian firms as well? And maybe my second question, which probably we have here also on our list, but how does it work you mentioned you pay quarterly. How does it work from an investor standpoint? What's the minimum investment? Sure. And then how does it work? I'm getting interest on the money I put, and then I get the actual investment back in a year or two. What's the holding period? All of that.
Yeah, well, so first I'll answer your first question. So we're allowed to do deals in Canada. We've actually pitched on a couple. We have not done anything yet because from an opportunity cost perspective, it hasn't made sense yet. Canada is federally legal. So there may be less, I would say, inefficiencies in that market. So we haven't done a deal yet. That doesn't say we won't, but for the most part, there are so many deals in the United States in limited license states. It doesn't really make sense because the limited license states are effectively oligopolies that have extreme enterprise value above and beyond the collateral and the loans. Go ahead.
I think to underscore that, even within the U.S., we haven't done a deal west of the Mississippi yet, so we haven't done a deal in Florida or Colorado. Now, we will look at deals, and there may be the top 10% of companies with track records are interesting, but our focus is really on the Illinois, Ohio, Pennsylvania, Virginia, Maryland. We're doing a deal in New Jersey, Massachusetts, so those limited license states that Tony mentioned, which make for a much more favorable environment from a lending perspective. And as for the investment mechanics, it's a private fund. The minimum is 500,000, but there's some discretion on our side if an investor wants to start smaller and grow to that number. There is, because we make generally loans with 2 to 3 year terms and amortization based on about 5 years, so we get a lot of the capital back relatively quickly compared to a typical real estate loan. there is a 2-year lockup. And after that 2 years, the investor can put in a redemption request and get some or all of his investment back at the net asset value. So it's basically a vehicle that is generating income. It's not a private equity fund where capital is locked up for 5 years, or a VC fund where it might take 10 years, because the underlying fund investments in our case are these short-term loans that allow us to give liquidity to investors.
Mm-hmm. And I think you answered my next question, I believe, Tony. How many loans have you closed so far?
We've done 10 deals.
10 deals.
Yeah, we expect to close another 4 by the end of the quarter, so end of the year. That, I think will be 20 to 40 million of additional capital. Once again, we are hyper focused on the limited license states. And there's, from a pipeline perspective, there's about $500 million worth of deals in the pipeline. Of that, we really are honing in on the best of the best from a collateral, cash flow, and an overall, structural perspective.
And then I think you mentioned also where you find your prospects. It's one of my questions here. And what size would they be? I mean, would you look at early stage, or maybe you've mentioned that, but again, if you can stress that as well.
Sure. Yeah, so in the beginning, when we started out, when we were less of a known entity, majority of our best deal flow came from, the centers of influence, the law firms in the space. There are about 30 of the top 100 law firms that have some form of cannabis practice. And then the accounting firms, Cohn Resnick's of the world, Markham's, they have made a decision to focus and build a big practice. So if they're sending you a deal and they have those type of professionals, running or helping their business, it's probably a good deal to take a look at. Now, since then, we've done a couple press releases, and because there is such a limited amount of capital available, and equity capital is extremely elusive, which is great for us. We get about 10 to 15 deals a week inbound. Now, 95% of those are probably not worth, they're desk kills. They're not worth looking at because they're more likely to be startups. But we generally like to have the existing proven operator who's cash flowing, has built a nice business, has been successful at cultivating, because it's not an easy thing to do. And that's where we want to deploy capital. Now, we haven't done many, but we will look at some earlier businesses. But that will really require a very low loan to value on the business, and generally some form of really strong personal guarantee to mitigate that early risk associated with a business getting started.
And can you talk as well about, for a second, the global cannabis industry? So it was a big, and as you know, family offices are very, I believe, are very quick to respond to trends when they see something interesting, right? Whether it was opportunity zone, whether it was cannabis, whether it was blockchain, and I think they always found the better deals because there are sophisticated investors that try to find the real deals and not what the masses are after. So so we had a bubble, right? I mean, the prices went crazy. And then I believe a year or a little bit more ago, it exploded a little bit. Yep. Usually what happens after bubbles, in .com, in every bubble, obviously many don't survive, and you stay with the better, survivors that are actually the real opportunities. How do you see what happened? If you can describe what's going on in the cannabis world.
Yeah, so I would say that, from a timing perspective, sometimes it's better to be lucky than good, because we timed this, right as the first bubble was bursting from an equity perspective. So the public markets got hit pretty bad beginning kind of Q1, Q2 of last year. Prior to that, we were talking to people, we were giving, quoting rates, high teens, maybe a piece of equity. And everybody was very reluctant to do a deal because they had the ability to raise equity at ridiculous valuations. Well, as that started to, reality set in, capital had become more and more elusive, especially equity capital. And the public markets was kind of the precursor, and everything kind of proliferated into the private markets to an even greater extent. So it was good timing for us, which then allowed us to get better terms and of course better type of deals, because our primary competition outside of sale leasebacks are equity capital. Now, fast forward to today, a lot of the bad operators are getting weeded out now. There's a lot of distressed M&A on the markets, and a lot of the deals that we're looking at are financing the acquisitions of these distressed operators or distressed dispensaries that are taking place for the businesses that did operate well and generate free cash flow and are great borrowers from a debt perspective.
I see, by the way, we have a question here, which is related to what we talked about here. How do you see the future of the cannabis industry in the US on the federal level? And second question is, maybe I've missed this, from where can you accept LPs? Only US, worldwide?
So for the first question, seeing how the industry evolves at a federal level, if the administration doesn't change, I don't think anything will change anytime soon. If Biden gets elected, I think we look at back when Biden and Sanders were fighting each other in the primaries. After Biden became the nominee, both camps got together and came up with what's called the Biden-Sanders Unity Plan. And there are 3 priorities for cannabis at the federal level. The first one is descheduling from the Controlled Substances Act and permitting medical cannabis, and more importantly, permitting research in the US on medical cannabis, something that you've had in Israel for a long time. In the US, because it was a class 1 or is a class 1 controlled substance, there's virtually no clinical research in the US. So that is number 1. Number 2 is letting the states decide what they want to do on recreational cannabis. And the third piece that has a basically social justice component of dealing with a large number of people who were incarcerated because of low-level cannabis-related crimes in the past. But in all this, I think that will take some time. And to see full federal legalization of adult use cannabis like we have in Canada will take many more years than probably a lot of operators in the industry hope for. If you look at Canada, they had something equivalent to the Farm Bill that we had in the US last year, legalizing CBD in the early 90s. Legalization at the federal level in Canada happened 18 years later in 2018. I think in the US it will be faster, but it certainly will not be overnight. And we think there's about a 3 to 5 year window for our current opportunity. I think as for the second question, we started our US fund because we primarily started with US investors. Now what we're doing is setting up an offshore feeder fund for international investors to invest because the yield that we're delivering is especially interesting also for Europeans, for example, that have negative interest rates. So we can accommodate international investors as well.
Now, we talked about how your investment process work in general. If you can maybe speak more on how you underwrite loans and all of that. I think you mentioned it briefly.
Yeah, so we're not reinventing the wheel here. We do typical underwriting that will look at collateral, cash flow, structure, guarantor. So in that case, we're looking at their financial statements in depth. In this business, we like to look at their bank statements. And one thing I do want to clarify, because it's always a misnomer, every deal we have done and every deal we will do has bank accounts. We will not do a loan if they do not have bank accounts, and for the most part is non-existent if you're east of the Mississippi. There are businesses out west that don't have bank accounts, but it is something that we don't.
How do you work with no bank account? How do you pay vendor? No, how do they?
They just deal in cash.
Really? So that's paying employees, paying vendors in cash?
Yes. And that's something we will not obviously entertain. So, the underwriting is, we get the bank statements so that we can verify their revenue and ultimately do a cash trace on their historical statements. On a collateral perspective, we get appraisals done. We use Colliers and CBRE to determine kind of the collateral value on a third-party basis. If equipment is part of our collateral, which we really is a very low piece of what we will actually lend on, we will consider appraisals on the equipment level. But then we look at kind of the collateral, the cash flow, the pro forma fixed charge coverage, and then from there, we'll do a guarantor analysis. In every deal but one, we have some form of personal guarantee. That is not so much for a credit enhancement. It's more to have alignment if you have some sort of, you have to exercise your rights and remedies. It's always great if they are wealthy, but you really have that for control reasons. And then from there, we go and do typical, once you have credit approval, we go through a traditional legal. In this case, we have used Denton's and Lock Lord in the past, probably firms that are pretty expensive for the size of deals we are doing. But in this case, these are both firms that have pretty robust cannabis practices and debt finance practices that I have worked with for many years. So those are, we do traditional legal setup, and we go and from there we close the loan. That's typically anywhere from 1 month to 3 month process, but it's a pretty deep underwriting because of kind of the nuances that exist in the industry.
And what's unique to lending in the cannabis space in general?
Well,
you just mentioned that some of the companies work on cash, which is crazy, but happy to understand more, about that.
Yeah, so the nuances that really matter in this business, if you're looking at, for example, a cultivator, every state, remember, is a different investment thesis. Every state has different laws. And so you got to kind of dig into that. There are some specialty laws that you really got to know from a lending perspective. But really, in order to measure a good operator, you need to see their output, because the price of cannabis in one state to another could vary by 75%. So a business in Pennsylvania could be profitable because the price is so high, but if you look at from an operation perspective, they're a poor operator. So we look at, from cultivation perspective, we look at pounds per square foot, pounds per light, cycle time, and how many cycles they get in a year. What's their cost of energy, because energy is a huge part of their cost of goods sold. And that's something we constantly measure, and we compare and benchmark from one operator to the other, because that's how you determine if they're great at what they're doing. Because cultivating specifically is very difficult. On the retail side, we like to always pull their POS data. We either get plugged in so we can pull it daily, or they send us weekly reports so we can look at their sales per square foot, what's their average ticket size, how many repeat customers do they have. All this is data that we really use to determine how good the operator is, because it's not an easy business, believe it or not.
And I think another point that's unique in cannabis is, for example, in the typical loan, there might be a $10 million building, industrial warehouse. There might be a couple million of accounts receivable and equipment, and we lend $5 million on that. That would be basically the collateral of $15 million. We'd be at a 30-35% LTV. But what's unique in especially the limited license states, if you, for example, have a grower processor license in Pennsylvania, the whole business is worth somewhere between 30 and 50 million that we've seen based on recent transactions of people selling their businesses. So if one of our borrowers were to run into difficulties, they could raise equity at a discount, or they could sell the whole business and pay off the loan instead of us having to go through a foreclosure and liquidation. And with outside of cannabis, in traditional industries, whether that's a manufacturer or a distributor, oftentimes there is not much enterprise value, that if something goes wrong, you have no additional protection. You have to go to liquidation and foreclosure very quickly.
Got it. So can you tell us about some of your loans? Maybe give a couple of examples, one, something that you can share with us.
Sure. So I can kind of go down some of the bigger deals we recently got done. And one we announced publicly was a company called Verano Holdings. This is a phenomenal business that's based here in Chicago, multi-state operator, vertically integrated. They're very big in Illinois. They are in Massachusetts, Maryland, Ohio, Michigan, Nevada, and a few other states to a lesser extent. This was a $30 million loan and about a 16% unlevered yield. From an LTV perspective, this is under a 50% loan to value on primarily real estate. We have an all asset lien on all collateral and exist stock pledge on all subsidiaries. And just say from an operating leverage perspective, we are less than 0.3x senior debt to EBITDA. Now, this business in a normal lending environment, senior banks will go up to 3 times senior debt leverage and will be charging LIBOR plus 200 or LIBOR plus 300. Here we have 0.3x of senior debt to EBITDA. And we're, about 5 times what a bank would charge. So that's an example of the spread and the arbitrage that exists. This case, we didn't get any equity or kickers in the business because we weren't, it was very difficult to get based on some of those metrics. Now another deal, and we have limited guarantees from the owners. Another deal, which happens to be my favorite, we closed about 8 months ago. It's a $10 million loan to a multi-state operator. They're based in Maryland, vertical in Maryland. They have a massive grow in Pennsylvania. They have a vertical in Virginia. They're one of 5 vertical operators in that state of 9 million people. And they have 51% ownership in an Ohio dispensary. So all amazing states. We structured as a delayed draw term loan. So $6 million is outstanding. They have the ability to draw 4 more based on predetermined metrics and EBITDA targets. And it's about a 17% loan. We have also 2.75% warrants in that business. And that was at a $135 million strike price, which was at that time a 30% discount to their most recent equity raise. Cashless exercise. And just to give you an example, they recently turned down a $350 million offer. So in terms of how that deal will look, if you go to maturity, if they do not sell prior to maturity, it's looking like a 35 to 50% unlevered IRR loan. And remember, senior secured, 17 million in collateral, stock pledges the subsidiaries, and they currently right now they have twice the amount of cash that they have in senior debt.
Now we have a question that actually comes in line with my next question. So they're asking if you're loaning against license value as collateral or mainly real estate and equipment. And I wanted to ask, do you get warrants with your loans? So maybe both of those questions.
So I'll take the license value question because it's interesting and I think also unique to the cannabis space. We are primarily senior secured lenders that focus on actual collateral. But what the difference is that in a more competitive state, if we were to do a loan in Colorado, for example, we might do 50% loan to value based on the collateral. If you have a retail property in a Boston suburb, which is one of very few there, which is a more limited environment, we might go up to 80%. So the license value drives our loan to value based on collateral. We would not give you a loan just because you have a license. Now, in terms of collateral, we do view the license as additional collateral because we have stock pledges of the subsidiaries of our borrowers. So those are the licensed entities, the operating companies. And if there were any issues that couldn't be resolved, we could actually foreclose on the stock pledge and sell that entire entity with its license to a competitor or another multi-state operator that wants to enter the space. It is more highly regulated than if you want to do that with a food distributor or a widget manufacturer, because it has to go through a state clearance process because the state wants to make sure that a purchaser doesn't have a criminal background or other issues. But there have been in states like California that are more open, but also in the heavily regulated states, limited license states like Pennsylvania, there have been sales of licenses between willing participants. So there's no reason why, for example, in Pennsylvania, the Department of Health wouldn't approve the true purchasers have clean backgrounds.
Could you repeat your last sentence? I'm not sure if it was a problem on my end or on your end, but it was a problem with your last sentence.
So I was saying that if in virtually all states that we are, there have been mergers, there have been acquisitions between willing counterparties. There haven't been any distressed lawsuits, et cetera, in Pennsylvania or Virginia, just because once you're open in the limited license environment, you do make money. But if that were to happen, we believe that we could exercise our rights on a stock pledge and sell the entity, the license holder, to a competitor in the state or to a multi-state operator that wants to enter the state, just subject to state approval of making sure that the new purchaser has a clean background, doesn't have any license issues. So we think that that's transferable. And actually, in the states like California, where you had some distressed transfers, there's actually a precedent for doing those transfers.
And so to that point, Denny, in California, what has happened for more distressed businesses, now California is not a limited license state, and you've had more a prevalence of distress. So bankruptcy protection does not exist right now for the borrower because it's a federally ran system, which in 99% of the time is a benefit to the senior lender. What has happened in those states is there's a state-approved receiver that effectively gets appointed and liquidates the collateral on behalf of the creditors. So they sell the inventory, they collect the receivables, they sell the license, and the proceeds are then given to the senior creditor. So there is good precedent set. Now, this has never happened out east because the businesses are worth so much more than any loan that has been ever given.
Now, there's another question here. Is the license transferable? How can you control the license? And it clarifies transferable to a lender.
So the license itself is attached to the entity, whether it's an LLC or a corporation who applied. So the license would not be transferred, but the ownership of the entity, the ownership of the licensed entity, that is transferable, or it can be controlled through management agreements. For example, in Arizona, the actual license holder is a not-for-profit entity, then contracts with the management company that essentially gets all the profits for actually running the business. If there was a default there, you can just take over the management company. We, as a lender, don't actually want to take over businesses. We're not a loan-to-own fund. We would rather, and I think that's a big if, most of the time, I think any credit issues can be resolved and the borrower would sell the business willingly. But if we had to exercise our rights, we would force a sale of the business to some other operator, not want to take it over and operate it ourselves.
And that's another reason why you want to get some form of personal guarantee, because you're much more likely, if you ever have to go through that rights and remedies scenario, you get a lot more cooperation when they have some liability on themselves.
And another question, before we go back to my list of questions here, is there any reason you are only operating east of the Mississippi? So resources, time, any business advantages just operating in the east?
Yeah, so, we're starting to look at some opportunities out west. That is really just a generalization. It really comes down to opportunity cost of capital, right? We have a limited capital environment. While we're getting bigger, there still is 10 times the amount of deals that we have capital. And so if lending to a company in Pennsylvania that has only 25 grow processors is a lot more attractive than lending to one of the 2,000 businesses in California that also has to compete against the black market, that also has, very bad state laws from a tax perspective, from a lender's perspective. So it really comes down to opportunity cost of capital and really getting the best risk-adjusted returns, which happen to be primarily east of the Mississippi. Now, we are starting to look at deals out west, but these are the top decile of deals that have not only been able to compete and generate great free cash flow in a tougher environment, but it's going to be, on the very best credits that are out there. It just, at this point and prior to this point, it really hasn't made sense.
And I think another reason why we like the states out east is because most of them, basically aside from Michigan, Illinois, and Massachusetts, are still only permitting medical cannabis. So like we've done in Pennsylvania or Virginia, getting equity in those businesses as warrants or equity kickers in connection with their loans, those become much more valuable when that state switches to recreational use eventually. So that's what we like, getting into a limited license states, getting some equity kickers while it's medical only, and then over the next 2-3 years, hoping for a legalization of adult use, which makes these equity kickers much more valuable. In Oregon or Washington, there may not be that much equity value in the deal.
I'm getting more questions, but we'll touch it. We'll go back to that. How has COVID impacted your portfolio? We talked about the industry. Do you have any defaults?
We don't have any defaults. I think we touched on that briefly because it's such a highly regulated industry. Both dispensaries and cultivators actually have to report to the state sales in pretty much real time. We plug into the inventory system or the point of sale system in the dispensaries, and like in late March and April, we're very interested to see how the numbers evolve. Because cannabis was an essential business, operations were not shut down outside of Massachusetts for a brief period of a couple of weeks. Some dispensaries switched to curbside pickup only, but what we actually saw is that revenues were up about 30% across the portfolio because cannabis on the medical side behaves like a pharmaceutical. That's not really driven by macro factors. And on the recreational side, I think you saw cannabis sales go up just like you saw beer and gun sales go up. So it's kind of anti-cyclical, and that's a big thing that we also like about the industry, that it's uncorrelated, or if anything, very lowly correlated to the macroeconomy overall, whether that's COVID or a recession in general.
Another question comes, but just I'm wondering if we should jump to that or continue with just a couple of more questions. Maybe before we answer the other question, can you share with us your growth plans?
So we are focused not just on underwriting loans, building a nice portfolio, but also building the firm. We started last year between the 3 partners. We hired our lead underwriter last year. He came from Wells Fargo, their specialty finance group. We hired a credit analyst earlier this year from CIBC, also in their specialty finance group formerly. And about a month ago, brought on another Booth MBA grad who worked in consulting for a couple of years, who worked at Stonegate with Tony a number of years ago to focus on portfolio management and operations. I think that's a big focus for us, is building out a team that can support the growth, because we view cannabis as a great risk-return trade-off, but we're not just building a cannabis lending firm, we're also building an asset management firm. So that's on the team side. I think on the product side, because it is such a nascent environment and senior secured loans are still fairly new. There's a huge suite of products, whether it's cash advances, factoring, reverse factoring, supply chain finance, that most businesses in the normal world have access to. In cannabis, with a company like Leafling doing it, there is 98% of the market that is untapped for other supply chain finance products. So that's probably something that we will partner with an entity in the space to roll that out next year.
Now I have 2 questions coming here just before I will go back to ours. When you say it would switch to recreational use, I'm not sure. Are there any lobbies working around that? I'm not 100% sure that such a switch would happen in the next 2-3 years.
So it depends on what is happening in the states around you. We've seen in the Northeast, actually Massachusetts permit recreational use, and now Maine followed. We've seen Michigan in the Midwest permit recreational use, and then Illinois followed. And you have recreational use on the ballot in New Jersey, Arizona. I would think if New York or New Jersey permit recreational use, then that will follow around. Now, for us, it is more a matter of timing, because these equity kickers that we have are really gravy. The contractual interest that the fund is owed and that we pay to investors isn't really affected by whether that happens, the value of the equity kickers. Whether it happens in 1 year or 3 years, that's really icing on the cake.
Another question, do you work with medical researchers such as, for example, Raphael Meshula of the Hebrew University, or any other folks like that?
We have not to date, because we're focused on the U.S. And I think, as we touched on previously, the medical research will come after descheduling from the Controlled Substances Act. So right now we're collateral-based lenders. I think we approach the space in a very prudent manner based on, looking at traditional credit metrics that you would outside of cannabis. I know there are a number of VC funds that look at the medical side, the more technology side, but that's to date not our focus area.
Another good question that we didn't ask, who are your investors today?
So it's all private investors. It starts from high net worth individuals, some registered investment advisors that look for niche opportunities that have allocated client monies, and then to the larger end, family offices that view us in their opportunistic credit bucket to take advantage of this regulatory arbitrage, both domestically in the US and in Europe.
I believe we spoke about the investment structure. Unless there's anything you would like to add about that.
I think just to clarify that, we have the U.S. vehicle that all U.S. investors can directly invest in. It's open to accredited investors and qualified purchasers. And then we are launching an offshore feeder fund that will basically be a limited partner in that U.S. domestic fund, but has a tax blocker. So any investor that invests in that BVI limited partnership would not have any U.S. tax filing obligations.
We touched that a little bit, regulation environment for cannabis here in the U.S. How do you see that? And more than that, how would things becoming, right here in the U.S. would affect your business? Would then companies need less capital from you guys because they'll just go to the banks? How do you see both of those issues?
Well, I think Tony has thought about that on our team, because he spent a number of years in the non-bank credit world, but he started his career in the bank world. So I think Tony has a view on how banks would approach this if it were legal.
Yeah, and ultimately, whether it's the SAFE Act or any other legislation that gives safe harbor to banking institutions, the reality is most of these businesses are still not, bankable for many reasons. Obviously they're beginning to generate free cash flow, but banks want audited statements. Banks want 2 to 3 years of positive net income. And it's still, banks are very slow to move. So to give you an example, hemp and CBD has been legal now for almost 2 years, but 95% of banks are still not operating in that space. Now, conversely, with the SAFE Act or something of its sort, we as a credit fund are much more likely to get a loan than an actual operator. And so while gross unlevered yields may go down a little, our ability to lever at a more, I would say, traditional basis will be easier, and our cost of capital will go down. So right now we are fully unlevered and we're generating, the returns we're doing. Once that becomes more doable, I think our ability to take, more one-to-one or maybe a little higher than that leverage will be there.
More questions coming. One is asking, are you lending only domestically or also internationally? I think you mentioned you're currently domestic, but I'll let you, if I'm wrong, let me know. And the other question is, the offshore vehicle in the BVI is tax-free for US taxpayers?
Unfortunately not. If you're a U.S. citizen or taxpayer, you have the privilege of paying U.S. taxes on income anywhere in the world. So it doesn't make any sense for a U.S. investor to invest in the BVI entity. But there is no U.S. tax and filing obligation for a non-U.S. person. So if you're in Switzerland or Germany and you're not a U.S. resident, that's where the offshore structure is very interesting. But for U.S. investors, you have to pay taxes unless you're a foundation, endowment, or through an IRA. But then either way, you would invest directly into our U.S. fund.
Perhaps we have like 10 minutes left. Speak a little bit about your workout experience and briefly about your team. Who's managing this whole operation?
So, for me, I started out at Wells Fargo Foothill out of college. I was a collateral examiner. So, at this time, Wells Fargo Foothill was known as, we did the really large asset-based deals, the more risky type deals that couldn't make it through the commercial bank. While I was there, I guess you could say I was fortunate or unfortunate enough to have to go through 4 liquidations. So I was the person they sent on the ground and effectively was there to collect out the AR and sell inventory. These were, deals anywhere from a $15 million loan and up to a $100 million loan. That's where I began, but most of my direct workout experience was with First Midwest Bank. We were the ABL and specialty finance group at the bank, but all commercial deals that went through workout really went through us. So I've had to work out of at least or over actually 10 deals and these are anything from pure liquidations to, forcing a sale to a strategic, but all different situations, but have definitely been there, in whether it's an ABC, receivership, bankruptcy, Chapter 11, Chapter 7, have had many deals going through that, and it's luckily we haven't had to use that yet.
And I think on the team side, at its core, Tony is really the gatekeeper that makes sure that we make prudent loan investments. He leads the underwriting team. He works with our 3 underwriters and credit analysts. I'm on the portfolio management side, and we're lucky to have our 3rd partner, John, who you haven't met on the call, but he's historically an operator. He built a hospitality company with 1,700 employees, 92 managers, started developing real estate on the retail and industrial side, and he heads the originations and business development. So he actually never stopped traveling this year, maybe only for a couple of weeks in March and April. He goes on site, and I think his value is 2 things. He, as a former operator, can relate to operators who are prospects who might become borrowers. He can really pitch our value proposition versus a sale-leaseback and show that we're a great financing partner, and also do due diligence and see things operationally that Tony or I with a financial background may not see in the numbers. So going in, looking at the operations of a cultivator or a retail store, that's what I think our big advantage is, that we have a very, very diverse team on the investment committee.
Brilliant. So any last comments you want to just double check we answered all questions? Yes, I think we have. Any last comments that you'd like to add here?
Well, Denny, I think you can. Oh, go ahead, Andreas.
I think I just wanted to say we love talking about our portfolio and talking about the individual deals. So if there are any participants on the call who want to learn more and actually talk about our underwriting and their deals specifically, we're happy to do that.
And also the one thing I want to leave you with is that, here you have, an industry that's emerging. Now it's estimated to be about an $80 billion retail value in the United States, 65 of which is still in the gray market or is considered illicit. So you have a market that already exists, and you have a transformation happening of going from illicit to legal. And so there's a considerable amount of value creation being done. And anytime you have this sort of situation occurring, the last time of which was probably prohibition. So you have a great kind of cycle ahead that makes for a lot of value creation, and it's good to have exposure to this industry, especially considering what's going on in the non-cannabis world. There's just a lot of volatility that is hard to price. So we're fully invested. The three of us have over $4 million ourselves in the fund, and we are, believe fully in what we're doing and eating our own cooking. So it's going to be a good next 3 to 5 years for the fund.
So you have skin in the game, which is very interesting here. Great. So first of all, Chicago, you mentioned, obviously, you guys are in cannabis, and as a group from Chicago, bearing Chicago's name, we were supposed to do our first conference this year in Chicago with very interesting local partners. So we're looking forward to do this next year in person in Chicago, bringing our families there. Cannabis has always been a space that we've known very well and talked about at our different conferences, obviously in Canada as well. Canada is one of our major markets. And maybe I'll just summarize and say what's coming up next at DC Finance. So we have a US Family Office online conference that is on November 12th and the 18th. We're doing it in 2 segments of 2 hours with keynote speakers, like I mentioned, like John Katsimatidis, the heads of AI at NVIDIA, Levi Strauss, World Economic Forum, Microsoft, H&M, Boston Consulting Group, and many others. If that didn't impress you, then I don't know what to do. But we have many other interesting folks just now, Kennedy family and Rockefeller and the owners of Hyundai and many other names that I'm getting that will be joining that. And we have a Canadian version as well that's going to be happening on November 5th and October 28th with great names as well, Patricia Saputo, Jacques Maury from Scotia, Bentel family from Vancouver, De Gaspé Bombian, some of the most well-known families in Canada. And last but not least, this week, on Thursday, as I've mentioned before, I'm going to have 2 sessions in one day. I've never done that before. At 11 EST, just like today, I will be speaking with Sarah Harrison, the next generation of the famous Harrison family and her work in philanthropy and arts. And then at 4:30, we'll be speaking with 2 of the most well-known doctors that are dealing with breast cancer and how they fighting that horrible disease. So that's the only time where they're not operating that we managed to get them here. So exciting stuff going on here. And I will not even talk to you about next week's sessions because I think that's enough to digest for now. So I wanted to thank Tony and Andreas for speaking with us. I don't think there are many people with so much experience that are working in a world like cannabis where there are huge opportunities. And I appreciate this discussion and their support of our online conference, of our in-person conference 2 weeks ago in New York. So thank you, everybody. We'll send you contact information of Tony and Andreas later on. And we'll take it from there. So thank you and stay safe, everybody.
All right, thank you, Denny.
Thank you, Denny. Thank you for everyone participating.
Thanks a lot.
Bye-bye.
Bye.